Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, oh wait, hold on. My music is screwed up here. It's Friday. Good morning, first. Oh, there you are, Uzi. Yeah. I remember it used to be every stream that it was like, you know, Uzi would be the first one. Well, let's go and see if the market's done anything interesting. Oh, looks like they are doing something a little bit interesting here this morning. Wow. So yesterday, I would say that yesterday was an update, kind of an update. You know, we had that big downturn and then it whipped back really hard. But we're still like within that area today. So, you know, it's probably splitting hairs there. Here's the S&P 500 still kind of struggling. Yesterday's downside wasn't as bad as the day before, but it still looks like the S&P is kind of struggling here. Oil, okay. Pretty decent downside yesterday. Gold and silver still looking pretty good, although silver has pulled back quite a bit. Copper still down there. Man, I feel like everything is just kind of looks Ugh. Okay, and the Japanese yen recovered a little bit from the drumming that it got the overnight yesterday. And Bitcoin, oh, Bitcoin's actually on the upturn again. That's interesting. So that 65 was as low as it was going to get that cycle, at least. Well, what morning, what's your thinking for today, Chop Fest? Yeah, probably. Although there is something going on. Well, so we got U.S. core durable goods. It was negative spot 8 versus an expected negative 1%. And we also had some Canadian numbers. But we get University of Michigan today. That's a relatively significant data point that we get. Consumer sentiment, I think, is going to matter. Because it's a kind of a predictive measure of future demand, right? And the market, the treasury market in particular, at least, is doing something. Although there is less liquidity out there. We got 3,000s out there instead of 4,000s like we've had most of the week. So it seems to me that there is something up. There is something up. I don't know if it's going to result in good action for us, though. Like, I'm kind of looking at this like, this looks like something that moves a little bit, but that I trade terribly, right? Because what kind of information do I have that's really going to tell me what direction the flows are going to be? I don't think we really have that. But, you know, maybe University of Michigan number helps us. How long from now? So it's going to be about 90 minutes. In 90 minutes, we'll get the University of Michigan numbers. And then, like that's the biggest stuff that we got today. Yeah. All right. So I'm kind of questioning how involved I want to be in the market today. We could get into the Ninja script again. I mean, that back test that we got with the order flow and everything, super exciting. It really sucks that it's taken that long for me to be able to like get that working. You know, just didn't have the time to work on it. Once I had a day to really look at it, it only took a day. Although I will say there's probably some other issues that I haven't noticed yet. And there's already some that I got fixed. Oh, so that's the first thing that I should do here is on my notes. Hold on. Some of these I probably need to close. You don't need to see all the notes about my job search. Oh no, we'll do it over here. Okay, this one. So, still working on my script for intuition and prop firms. I actually think that really, like, if it's like, what's the best video to make, we want to get that one out next. I have 2 that I've already recorded that we'll be putting out, but like, what do we record after that? It probably should be the prop firms are for suckers. Oh, by the way, we should talk about this. Let's start here. Where's that link? Where's that link? Here it is. So, this showed up on r/day trading. This guy, Tom Hogard. I'm not a fan of this guy. I think that he's kind of like a bad actor too, and he's just kind of presenting himself as a white knight. But, you know, I don't really watch his content or anything, so I don't know that much about him. But apparently somebody posted this on his forum, and it's been like repasted everywhere. I had a conversation with an individual who works for a, quote, funded challenge company. I promised 100% anonymity, and I will respect that. And this is what the individual told me. I ask you to ponder on this and contemplate what to do with this information. The funded company claims their clients are trading real money. That is not the case. Company takes in about $25 million a year in fees paid from challengers. That's insane. 25. So like, remember when Warrior Trading got sued by the FTC or whatever the deal is? Or like the thing with Vinny, like he was like $1 million, and I think that Ross made like 5 million or something like that. These companies are making 25 million a year. The company uses tactics to ensure that only 1.5% of all users of the challenge go on to trade a real account, although earlier he claimed that they're not real accounts. In other words, 1 to 2 people per 100 will get funding. The company works with social media influencers and helps them edit their trades and their profiles to ensure they appear profitable. That is fraud. That is fraud. If you can prove that, you can go to the FTC. They will give you a reward. Like whoever this came from, this individual, if you can prove any of this stuff, you should get a lawyer, have that, you know, because you get a lawyer to negotiate with the FTC, and you will probably get a whistleblower reward. And especially if they're taking in $25,000 a year. Yeah, you could get like $1 million whistleblower payout, because that is fraud. That is fraud. Of the 1 to 2% who receive a funded account, these accounts are now a liability to the funded company, as they are still trading a B-book account, although it appears to be a real account. That's also fraud. If they tell you, most of the funded trader companies tell you, you know, oh, this is actually just live sim, right? So if they were putting you on saying that you're live and it's live sim, that's also fraud, right? The company pays out no more than 1.5 to 2 million a year to people who make money on their funded accounts. That's actually more than I thought it would be, but okay. Point 3 is, in terms of how do they ensure that only 1.5% of users of challengers go on to trade a real account? They say point 3 is achieved through the use of price spikes that will stop traders out even though it is not reflected in the real market. These are marginal differences and will often be unnoticed. There's no way to complain because it's not a regulated industry and challengers are trading on demo accounts. So that makes, when I first read this, and I think I even said that, I think I want to delete my comment actually. Where was it? I'm gonna delete that. Because this guy was saying, oh, maybe it was this firm or this firm, and I kind of thought that it did sound like that firm, but it's got to be Forex. Because if it's futures, that's all done through Rhythmic, and I don't know how they would do that. So it's got to be a Forex broker, a Forex funded trader. Yeah, virtual dealer plugin games. Like, that's exactly some of the stuff that we know Forex brokers did, huh? There was some Forex brokers that were doing that with real, because you're trading against your broker when you trade Forex. Let's see here. With social media influencers, the way that they achieve this is by recording videos in replay mode, and the underperforming trades are edited out professionally. The individual told me that one of the most prolific YouTubers is on their payroll, portraying himself as a successful trader with an impeccable track record. The reality is that he has never passed a challenge, and he serves only as a tool for the marketing funnel for said company. Fraud. That's fraud. That the company that would handle that kind of fraud is the FTC, Federal Trade Commission. And those are some of the reasons that they kind of went after Ross Cameron from Where You're Trading, and they had that whole thing. If you have that information and you can prove it, I would get a lawyer to negotiate with the a whistleblower settlement with the FTC, and you probably will make a ton of money. You'll make more money than any of the people trying the combines, I'll tell you that much. The New York Stock Exchange just announced plans to extend weekday trading on its NYSE Arca Equities Exchange to 22 hours a day. If approved, extended trading would be from 1:30 a.m. to 11:30 p.m. Eastern Time. Oh, okay, so that's interesting. So there would still be a stop overnight, but it would only be essentially 2 hours. Whereas right now, between, like, I want to say 5 o'clock and 11 o'clock, you can't trade. All U.S. listed stocks, ETFs, and closed-end funds would be available for trading. That actually is a relatively significant deal, isn't it? Although, like, for futures, like trading the extended session in futures, like you can do it. There's actually some reasons to do it because you get trendy markets during those times, right? Like, this is one of the things that I keep kind of coming back to and realizing when I do back tests is that so much of the positive, especially in equity indexes, so much of the positive action happens overnight. That if you're not in through the overnight session, if you just day trade, you're missing out on half, if not more, of the potential gains. But for stocks, don't buy and sell stocks after hours, man. Like, you just always get screwed during that time. The spreads that they give you are ridiculous, and you just always get a raw deal. I wouldn't buy or sell it aftermarket. Well, anyways, I wish that I could include this stuff about this person claiming these things about these funded trader companies in a video, but it's anonymous and like you can't prove any of it, so I don't think I can put that in a video. Because I'm kind of having an issue like with this video. Which one is it? Yeah, this one right here. So I got this video, and I'm like, okay, it's for suckers. I don't like them. And then I walk through the Monte Carlo simulation and show them this is how many people pass. And now that you understand the statistics behind it, you can kind of understand why the funded trader programs have some of the rules that they do. where do I take it from there? Like, where do I take the video to a logical conclusion that people will want to sit around and watch? You know, I feel like it's kind of like a video with a great premise and on a subject that people, but like no ending. Because I guess the ending is, well, I don't like prop firms and you probably shouldn't trade them, but they're still out there and you probably are going to trade them because it seems like that's what the majority of retail day traders in the future space do anyways. I mean, if you do it with limits, well, sure, if you get filled on those yeah, maybe. I watered my plants yesterday and I can smell, you know, that smell when like the dirt gets wet and it's got that weird smell. Plus, I left the window open last night, so it's really cold in here. It's actually kind of nice because I've been sweating hard. I've been sweating hard this past week. Yesterday, it was so hot in here. It's better than hitting into an... Yeah, well, right. But probably what happens in that situation, right, is that when you actually get hit on your limit order, probably the next best limit order is like the whole spread further again. So it's like... as long as you're getting the price you want, I guess. I don't know. Keep giving you my thoughts. Keep giving me your thoughts, especially on this combine thing, if you have ideas about where we should go with that. But I actually have some oatmeal that I was going to eat. So let me eat my oatmeal here, okay? So while I'm eating here, I just want to note in the market, you know, it was a decent 15K move up, and the amount of volume on this pullback seems to be relatively significant as well. So I am seeing a little bit more volume and activity than I tend to see on like a slower Friday. And the liquidity has firmed up a little bit as well. At least on the offers, we've got like 4Ks up there now as well. So I'm still kind of seeing something that's giving some signs that there might potentially be opportunity, just not any kind of opportunity that I have any kind of a finger on in terms of what the future flows are actually going to be. Dude, the r/advice animals subreddit, like all of the posts today are basically like Trump is Hitler. As Trump is mustache, I should say Trump is mustache man. But like I'm telling you, man, that subreddit, it's astroturfed. I'm 100% convinced it is all astroturfing. It is just insane. The stuff that's coming out of that subreddit every day now. Trying really hard not to fall for the red mirage. Well, it is. I get how you feel, right? Because in 2022, all of the information that we had suggested that Republicans were going to do really well, right? And they did not prefer. Well, my understanding, or rather recollection of it, wasn't that Republicans like underperformed as much as it was that Democrats really outperformed in the 2022 midterm elections. And so it would be natural to be concerned that we're falling for that again, that there's something wrong with the polling and et cetera, et cetera, et cetera. Well, so here's a couple of things about that. The main one is that it seems that the Donald Trump supporters that are helping him win basically only show up for him. They basically only show up for him. And they did show up in 2020, just not to the degree that they needed, right? The other thing is that a lot of these less engaged voters that do show up for Donald Trump only show up during presidential election years and not midterm election years. So we do have some reason to believe that what happened in 2022 is not what's happening right now, right? I've actually seen a number of good arguments to suggest that the polling that we're getting is actually incredibly accurate. That would probably be the biggest surprise of the whole election, wouldn't it? That the polling is actually accurate this time. But, you know, the polling is pretty much all going in favor of Donald Trump winning. I should like be really, so like the thing is that the margin here is not huge, right? It's not like Donald Trump's running away with it. Like, you know, he wins 60% of the popular vote or something like that. Like the margin is still razor thin. Although, with the way that the current polling is going, his electoral victory comes out to be pretty huge, right? His electoral victory turns out to be pretty huge. But the thing that I see is that the polling matches what I would expect to see based on what's actually happening in the campaign, right? We saw that bump that you kind of get when Kamala Harris came in, and then there was the convention. Then there was the convention. And after that, we kind of expected that she would fade, and then it would be a close race, and she would be forced to go out and have to do things, and then all of her candidate weaknesses would come into play, and that did happen. And then the next thing was, like, you could see it in the play-by-play, where each little mistake that she made, and you could see it shift in the polls. So I think just based on Kamala Harris's performance as a candidate, that the polling matches what I would expect to see as well. That you have like a very divided country that's voting mostly based on party lines, but one party's candidate is so inept that they just can't get their voters to come out, and the other one has a broad enough coalition to kind of pull up an upset in parts of the country that are, you know, typically vote Democrat and get an upset there. So I think it all matches up. It's pretty crazy to think that we're only like, 10 days away? Well, it's more than that. It's not next Tuesday, but the Tuesday after that. Still, it's super close, right? Now, I am starting to see, well, man, yesterday, I'm not going to go into the stories. I got to be careful. One of the things that I'm trying really hard at, guys, is we have to talk about politics, but I don't want to be extreme politics. Like, I'm very Republican, okay? I see some problems going on, but we need to have content that is still, like, advertiser friendly and is not extreme. Like, I look at some of the stuff that goes on Twitch, like Hassan, the stuff that Hassan says on Twitch. It's just like absolutely insane. That website is going so downhill. Okay, we don't want to do that. I gotta be careful, and I'm really trying to keep my analysis of the politics to be informative. Like, that my focus is we're trying to predict what's happening and understand what's happening, and not necessarily trying to push my political opinion, even though it's going to be in there, right? So I'm not going to go into the stories, but there was at least 3 separate stories yesterday that were like Donald Trump October surprises that were basically like all roundly mocked and debunked. They were like, oh, we have this picture and all these sorts of things. I was like, okay, so then where is it? Because now's the time to be putting it out. And you not have it now. They're lying. This is just people on Twitter lying and stuff like that. Ooh, that reminds me. What was the thing on the Republican side that we thought must be fake? Oh, what was it? That person's, it was the one that had the whistleblower from ABC, and then Oh, yes. The saying that Tim Waltz had an inappropriate relationship with a student. And was that earlier this week? Or was that last week? But, yeah. Oh, the guy's account is gone? Okay, well, there you go. So that one was fake. Now, one kind of opposition dump sort of thing that I saw yesterday as well, that I kind of consider an October surprise, even though it's not about the candidates, was a story came out from the New York Times saying that, was it the New York Times? I think it was the New York Times, yes. Saying that Elon Musk was speaking to Russian and Chinese authorities. And I'm seeing Reddit pick that one up really strongly. Now, the story noted that he hadn't said anything that was disqualifying, and he's keeping his security clearance and all of these sorts of things. But that does really strongly seem to me like a story put in there just before the election, because Elon Musk is having, it seems to me that he is having a small impact on the election as well. So there was that one. Like, we're in the opposition dump time period, right? And what I'm seeing, I guess the whole point of all of that was, I'm not seeing a significant game-changing October surprise. Like, I suppose that you could do something next week, but I really think that people would need more time. So, I don't think that there's going to be a really big game-changing October surprise this time. Some of the mindset be backpilled, but still vote. Yes. I've seen so many people saying that like they think that it's rigged, but I'm still going to show up to vote in protest. And, that I kind of feel like that. Like, I'm not in the election per se, like, because I don't necessarily think that the vote is rigged or anything like that. But, like, there's some things about the economy in our society that I think are, really... Well, listen, life's not fair. I'd expect it to be not fair. But what bothers me is that there's this facade that it's like presented as one thing when it's clearly not that. And I think that a lot of people use that to give themselves an excuse to not try, right? They adopt that opinion because it means, that means it's okay for me to stay at home and be lazy because the whole system's rigged anyways, right? But my takeaway from it is, okay, so if we're going to be successful, we have to be so good that we just can't be ignored. Like, yeah, it's rigged against us in some cases. It's not completely fair. People that already have capital have a huge advantage over us. The way that the futures market works is just explicitly disadvantageous for somebody with limited capital. So what do you do about it? The only thing you can do about it is be so good that they can't stop you. So I have to work even harder. That's the way that I think. Okay, 007, quick question. I want to develop an algorithm in Python based on the DOM and footprint data for horizontal analysis. Okay, I don't know what you mean by horizontal analysis, but maybe you're talking about something that I just haven't gotten into and I need to read about. I want to examine traded volume at each price level to identify potential turning points. For diagonal analysis, I plan to compare bids with offers to detect buying or selling pressure. Well, so the first thing is that, looking at the volume traded at each price level, that's basically the volume profile, right? And what you're going to find, as I describe in my improving volume profile video, is that there is a normal distribution that will show up in most volume profile days. And that distribution tends to correlate well to locations where a liquidity hole formed and price stayed in that area for a very, very long time. And that's what creates that distribution. And that does not necessarily provide an edge. and comparing bids and offers. So if you look at the book and you look at like, are there more bids or more offers, especially like the inside bid and offer tends to predict on a short time frame whether we're going to tick up or down, and tends to correlate to what the current trend is. Generally overall, when I've looked at it, it seems to me that it does match just what the trend or the moving average is, and so it doesn't help you over a moving average. But I do suspect that if you got into creating a Markov system with that you might be able to develop a slightly better edge with that. But I think that to really develop like a really strong edge there, that you're going to have to go even deeper than that. So you're probably in like a good starting place, but just realize that like that's just the beginning. The big thing that you're going to run into, and kind of the place that I'm at right now, is collecting the data is like one of the biggest parts. The better your data that you have to be able to back test on and so forth, that's like a huge advantage. And like depth of market, that's not data that people provide, so you have to save it yourself. I have a lot of data saved up myself now. Tell me a bit. I don't know. Like then the next thing is you can utilize machine learning as well, right? Now, my understanding is that you have to be careful with the way that you utilize machine learning, because a lot of machine learning, most machine learning algorithms are basically based on Bayesian logic. So it's the main gist of it. Because what you do in Bayesian logic is you kind of have like a running percentage sort of a thing, and like as you get more data, you can adjust your Bayesian prediction based on the data that you've gotten, right? And that's kind of what machine learning algorithms are doing, is they're adjusting with each data point that they get to zero in on something. And the problem with that is that that's kind of like mean regression / standard deviation kind of analysis, and markets are fat-tailed. So you kind of have to use a different set of tools to deal with a fat-tailed market. And I've never really gotten very well into information that kind of tells me what the answers are there in that. So I don't know what you're supposed to do. Yeah, I don't know what those tools are. I have this one book. It's a book by Halperin and Dixon about artificial intelligence for finance, machine learning for finance. And I think that some of it, I might get some idea in that book, but then like that book is way too deep for me, because it's kind of explaining to you how those algorithms work instead of like what the tools are. So I don't know. And then maybe those, you get into those tools and they aren't necessarily useful for scalping. Maybe they're more useful for like, if you're trading a bond portfolio or, market making things like that. So I don't know. But I mean, I guess the thing here is that what I'm trying to get you to realize is like, this is a journey where you kind of have to go out into the unknown and learn things that very few people know. Or that nobody knows, and discover something new, right? Because if it was something that was just available online and shared willy-nilly, then it probably wouldn't be an edge anymore. It probably would already have been taken out of the market. So Octavius, I'm having oh really? I mean, you had a couple of good trades in there, but I feel like that overall, guys, like the markets just seem kind of not very inspiring right now, aren't they? I would kind of chalk it up to just the election, but I'm kind of suspect. So here's a nightmare. Well, hold on. I have a little bit more food here. Let me eat before I get into another big rant. Have you looked at Spot Gamma? So I've never looked at their API. You're talking about their API, but I would say that the Gamma is something that we have a decent amount of evidence to suggest that there's something to it. And, you know, one of the reasons why I don't really trade equity indexes is because I kind of feel like that's one of those tools that I would probably need to have to be competitive in equity indexes. But, you know, I haven't really used it, so. Actually, what I had does have chia seeds in it. I didn't put cinnamon. I should put cinnamon in it, but it's hot. I just sweeten it with honey. It's kind of, I don't know what the deal is. It's like steel cut oats, but like it's instant steel cut oats. So I don't know what they do to it to make it instant. That might make it not good, but whatever. Okay, so what I was going to say is one of the scenarios that concerns me that I don't know why I don't like have any. No, they come in. Oh, maybe I have sacrifice seeds. Anyways, I don't have any reason to think that this is going to happen. It's just like a scenario that's popped up in my head that seems to fit the situation. So maybe this is just intuition. I don't know. But like the scenario is Donald Trump wins the election and then, there's like a brief rally and then everything in the market starts falling apart. It's like, so especially this scenario where like, all of the data is fake and they're misrepresenting the job statistics and things like that, right? But well, if that was the case, then as soon as Donald Trump gets in, the numbers are going to start looking bad, right? But I can kind of see this thing where it's like, oh, Donald Trump, that's generally good for markets, but then it's like inflation is still a concern and trade war and like the markets fall apart. And when the markets start to decline, like really decline like that, because we've had pullbacks, but they've just kind of been, I don't know, not really meaningful, right? I'm concerned that at that point, that then all of the problems that we do have in the economy right now kind of get exposed. Well, like one of the big problems that I see is that we have like what I would call an upside down K economy. So like when you look at jobs and like we're creating a lot of jobs and stuff like that, but when you actually dig down into those numbers, the majority of those jobs are either lower income jobs or government jobs. So government and lower income people are kind of, things are getting better, but like things were never very good for those lower income people, right? And the part of the economy that typically would do well, like especially tech workers, are really hurting right now. I'm not just saying that just because I'm in between jobs. Like all of the data that I've looked at this, did you know it takes the average worker, the average white collar worker, 26 weeks to find a new job right now? That's a startling statistic. I don't, I'll be hurting after 26 weeks. So far, we've been doing okay. And by the way, I don't make very much from this stream / YouTube channel, but we did make more this month and I'm able to eat. So thank you very much, guys. But yeah, and then at that point, it's like full on recession, right? Full on recession. I read that M2 is increasing at a faster pace than it was during COVID. Nah. Well, okay, so let's go look. Let's at least see what Fred says. Fred M2. How much do I want to zoom in on this? So it's kind of difficult to see the trajectory. Like here's the longer term trajectory. Is this line right here is maybe actually slower. So based on the data that we have on this one, I would have to say that M2 is not increasing at a faster pace than it was during COVID. If you look at it in growth percentage terms, it's going to be like the amount that's being added per month is going to be higher than many points within COVID. But I think that that's incorrect. You know, that thing is incorrect. Just have to point out though that like wasn't just the M2 money supply, you know, the money creation that caused inflation. So don't you look at daily settlements on that really? You still think it's Salim? Maybe. I mean, I thought Salim was too busy with school. Salim, if that's you, we need to talk about why you're not taking school seriously enough. Probably. Don't be running around trolling on the internet. You need to focus on your college work and go and get a good job and make big money. Counting on you. Hey Gus, how have you been? I haven't seen you in a while. I've actually had a good number of people stop in and say hi. I was wondering, because, you know, so something that's happened this month is I've been getting a lot of, let's say, like, I don't know, I wouldn't even categorize them as sponsorship, but a lot of emails from, like, vendors, let's say. I've been getting a lot of emails from vendors this week in particular. Like, every day there's something from somebody. And none of it is anything that I'm interested in. I got one yesterday that was like this AI thing. They're like, oh, it gives you 95% entries with artificial intelligence. I'm like, that's probably bullshit. No interest in investigating that. But I'm wondering if like it's because we put out a video last week, you know, and so like the algorithms have picked up. It's recommending it to you guys, and so some of the longer run people that haven't stopped in a while saw us and like, hey, let's say hi. Is that what it was, or were you just thinking about me, Gus? But either way, I'm glad to see you here. How have you been doing? Well, I'm between jobs, so I'm gonna say not very well. Not very well. But just thinking about. Oh, thank you so much. Most people don't think about me, so that's so great. That feels so great. I got the warm fuzzies now. No, yeah, I'm hope for a good. No, it was a terrible reason. It was they were looking to reduce headcount. They were showing all of the signs of looking to reduce headcount, and I unfortunately slipped up and got caught up in that. I'm really, man, I try not to think about it or talk about it, but I'm really mad about it because I had been working in a place for a long time. It was pretty good setup, you know, but they gave me, I only left because I got headhunted very aggressively by this other company, and I got a pretty decent pay raise, you know, because I'm doing site reliability work. I was not originally hired at my previous, the older than that company for SRE. I was hired for something else. And so I had not fully gotten like my raise for being an SRE, right? So I switched over to, you know, that and got a really big raise, right? But it was basically like they suckered me in. So they suckered me away from a much more stable job just so that I could only work for them for a year, and then they, coach you out of the, basically it's a layoff without having to do layoffs, but good grief. You gotta subscribe again. Oh, you don't have to do that. I will. So one thing that we got going now that you might be interested in is on Discord, because you get so much private message spam on Discord because of the robots. So we're always going to keep that free Discord going. But if you go to the free Discord, there is a link in the announcements channel for a paid Discord that's $3 a month. So if you do the $3 a month Discord, and there's a decent amount of activity there. I've been posting the Bitcoin pictures there. I'll probably do that again today. And I hope to be putting some more content up there as well. And it's only $3. So you do that. Because here's the thing. If you guys want to help me, because I really appreciate it. And I really can't do this without you guys. How many people are in there? So I think it's still less than a dozen. But there's been a decent amount of activity there, especially in the interest rates channel. So there's about as much activity in the $3 Discord as there is in the free Discord. So pretty happy with how that's going. But that's the thing is what can you guys do that helps me the most is it's like participating and stuff like that, right? Like you go to Discord, you comment on the Discord, you go to my videos, you leave comments on the videos, right? Because you could subscribe, to my YouTube channel for $5 a month or whatever the deal is, right? But I would make more if you went in and you just left 2 comments on videos, right? Like 2 comments on videos, and the amount that boosts us in the algorithm and the advertising that comes in is probably worth more than $5. No joke. So, and then especially if you're out somewhere, when you share a link with somebody to a video, then that really, really helps the channel out, right? And those would be the things that would help me out the most. If the channel grows organically, there's a certain point at which I would be able to live off of it. And it's actually not that far off, given the way that things scale. All it would take is one good video to really pop off, and I could probably live off of the stream. So it's kind of, now, live off of the stream is kind of, I should put a big qualifier on that, right? I will be able to eat and pay my bills, right? But my wife has switched over to working full time. So, I only have to make a little bit from this to pay for the bills. To recover the income that I lost from the day job, then we'd probably have to be 100,000 subscriber YouTube channel, right? But anyways, you should make a video just talking about that, actually, how to help me out. Well, I try to put in every video, I'll make the call out actions, those, ask a question, like the video, subscribe. Those are the things that help. Make it a deep, but I kind of already have that with the order flow video series, right? But the next 2 videos that we have coming out are about order flow stuff that we talk about, misconceptions and ideas out there that we get questions about on the stream a lot that I've made a video for. I don't really need to go into that because I already talked about it, but I've got 2 videos. I guess today my plan is to finish editing up at least one of those One of them, well, I've done all of the A-roll cuts essentially. So watch over that again and just kind of spruce that up. And then the first one, I don't know if there's going to be too much B-roll. But the second one, there's, I want to add a decent amount of B-roll to show what I'm talking about. So, spend some time editing that. And then go back to my order flow indicators. Because that's like so what's the thing that I can do? I really feel that my indicator suite is so valuable. And it's really something that I think that everybody that has NinjaTrader would benefit from getting. And it's a very reasonable price. And, I could probably sell it for like $1,000 a pop. But, my plan is to scale the price according to the demand. So right now we get a few buyers a month. When that goes up, I might have to increase the price to deal with the, more people to support, essentially, right? You're re-downloading him? Yeah, well, so I'm going to be putting together, I think that I want to test this and watch it for a few more days. But and then there's a larger change. Yeah. See, so after I'm done editing the videos, then I want to get back into working on these indicator suites, because I've made some improvements in the caching. There's like one change. So it was earlier, I was going to write this down, and then I didn't. Space B. We got straight into these things. So like the next video that I want to make is prop firms are for suckers. Okay, but here I'm backtesting cache data. So there's a couple of subtasks that I need to do. Update all indicators to new caching class. I have like a class that does it all now. And then I also deal with rollovers. So like the month is in the name of the file. And so I'm reinstalling Ninja. All my systems are in Linux. I'm curious to see how it compares with Signals. Oh, interesting. But anyways, guys, the big change that I've made is that the order flow indicators that cache the data, like as it runs live, it saves the information to disk, and then you can recall it historically, works in a backtest now. There was some problems with it. I've kind of figured there was 3 main problems with it. One was that I was using session iterator in a subclass. You can't do that. You have to have it in the class of the indicator that's running. Another one was that there's some issues with like, are you using the current bar or the bar previous? And if you go in and you set the bar previous, that doesn't trigger it that, oh, we've actually have a value for the current bar. And so that kind of screws things up, because then you go in to get the value and it's not there. And then the third one was that you just have to use the right method to make the calls and so forth. Otherwise, again, NinjaTrader doesn't realize that there's a dependency there and that it needs to evaluate that before it does this. So you get all of these kind of concurrency problems. So I fixed those. And then there was some other issues where like it would only load the first day, or, those sorts of things. I fixed all of that. So now I'm going to apply it to all of the order flow indicators. And then you can run, so what you would do is put the indicator on a chart, right? Collect data for a year or however long you want, and then do back tests on it. You'd have to have it like on a chart and like collect the data, but I have that. I also think that I will include the data pipe in there. So the data pipe will output like literally everything, Just warning you, if you like leave that on all day, and it's like you'll get like hundreds of megabytes a day, by the way. It's a lot. But it's there. Then you could do the stuff like the analysis in Python. So yeah, now I did a back test. For those of you that weren't here yesterday, I did a back test just on like the 2 months of data that I have. And as long as we keep to our time period, it worked really, really well. So I highly doubt that those results would hold up under more data, but it is promising. It suggests to me that, like, you know, with some other more sophisticated things added on, that we might be able to get a really good order flow based scalping robot. So I'm kind of hopeful on that. So yeah, I'm kind of working in that direction because I think that the indicators are super valuable. How to break into quant trading firms having 2.5 years of experience of trading these bond futures. Yeah, you know what, man? What I've noticed is with the firms is that if you want to trade, you basically got to do it like right out of school, right? Because what they do is they hire interns and they hire people out of school, and if you don't have any existing experience in something like that, you know, your resume won't even get through the robots. So, and then on the other side, you might say, well, maybe I can get myself into a firm with the job that I'm doing today. Like if you're a tech person, get in there as a tech person and then maybe make the lateral move. And what I have found there is that doesn't really work very well because nobody really cares. Like none of the tech people are interested in the market itself. It's just a job to them. And you being interested in the market is kind of annoying and or threatening to them, in fact. So I don't know if you're a regular person, you're day trading and you want to move over to an institution, how you do it. I really think that some of you guys, you know, with the training and resources that you get at a firm, could beat those institutional traders and be the best institutional traders that they have. But how do you get your foot in the door? I don't know. But if you're a kid, then do really well in math, man. Do really well in math. Do you run Jigsaw through Ironbeam or NinjaTrader? No, my broker is EdgeClear and my data provider is Rhythmic. And the way that I connect my platform up is I use Rhythmic Trader Pro is what connects to the data. And then both NinjaTrader and Jigsaw then get their data from Rhythmic Trader Pro. Get certified and go solo, start a fund. Yeah, well, so I have all of the things that I would need to start a fund. All I would need is like a long-term strategy and people willing to invest in it. $10 million. I need $10 million. So if you have $10 million, you want to start a fund, talk to me. Otherwise. So one of those things is that, like, you know, I'm always kind of putting feelers out. Like I'll put a video out and like how people react to that video kind of determines how much I'm going to spend on that stuff, right? So the last video that I put out was about our index funds evil. And that's kind of like my big issue. That's the thing that like is the biggest deal to me, is that we put all of our funds into index funds and it's kind of ruining the market. And we've got to figure out how we're going to deal with that. That's like the discussion that matters the most to me. But yeah, I put that video out. It didn't perform very well, guys. The first week of that video was like now maybe it's because I haven't posted in a while, but that video didn't do very well. Maybe the thumbnail just sucks. I don't know. Maybe the thumbnail just sucks. You are well, so I have a Series 65, which allows me to be a registered investment advisor. and would allow me to, like, advise people on specific investments. I could partner up with a broker, and I would manage the account. Like, the client can give me the money, and I manage the account for them, right? So I can do that. And I also have a Series 3, which means that I can do like a commodities trading pool or something like that. So if I wanted to make a hedge fund that is a commodities trading pool, which would basically be like trading long-time momentum on daily bars, right? That's the way that the majority of that industry works. Like, I could start a fund like that. I could. And it would take me a few $1,000s to get started, because there's like some legal stuff and everything, but like I have all of the education and everything squared away. I would just need the $10 million. All right. But also interesting that you're coming back in, Gus. Oh yeah, so update the indicators to new caching class, deal with rollovers, and then I think I want to make add options for names for file name. Because so one of the things with the file name is that there's in the indicators it generates a GUID, and it uses that GUID to determine what file to write into. And the reason that you have that GUID is, like, what if you want to add the indicator 3 times to a chart? How do you differentiate the 3 different times on the chart? That's why it has to have the GUID, right? But that's kind of like a niche case. Most of the time, you guys are probably only going to put the one indicator on the chart, right? And so I would only need the indicator name and the chart, like it's a ZN 1 minute. And that's probably like all you need in the name. And that would make it a little bit easier. So what I can probably do is I can just make like a little switch that allows you to say, oh, I don't want to use the GUID, or I do want to use the GUID, and all that sort of stuff. But then I have to change the name, because right now the rollover is in the name, and that's kind of a problem, because then whatever you're doing when you're trying to pull it up for backtesting has to be able to predict the name, and I don't want to have to use the maturity. So, because when you're using the backtester, it kind of screws that up. So those are 3 things that I know I need to do with it, and then make a release. Oh, let's add data pipe. I said that. Make release. That's a big gamble for Mr. 10 million. What's your sales pitch look like? Okay, so here's my sales pitch. We're going to make a fund that everybody can invest in. So typically, you can only invest in a fund like that if you have a big amount of money, like $10 million, like you mentioned, BS, right? $10 million is like the minimum amount that you need to start a fund for, like all of the math to work out, and for the fund manager to be able to live and, give his whole effort into that. But there is a way that otherwise you have to meet certain income requirements, right? But there is a way to get around those income requirements, and there's a test. There's a test coming that will allow you to become a qualified investor, essentially, so that you would be able to invest in things like private equity and hedge funds. The problem with that, though, is that after you take the test, there's not really any opportunities for you to invest in, because they're all still require large amounts of money. So there's nowhere for you to invest in. So my idea is we make a fund that allows that is designed specifically for those people. Sorry, I'm not giving a very good sales pitch here, am I? We make a fund that caters specifically to those people. So, yeah, we'll let early investors in that have the money to get the fund started, your $10 million, right? But then after that, we'll leave it open so that people, they can invest a minimum of $1,000 into the fund and we're specifically going after these people and helping people get educated and go in to, pass this test so that they can invest in the fund. And by having so many investors, we are basically opening up an entire new section of capital to this kind of market, this fund. And so that will, in the end, provide us more resources than other hedge funds. And that will be able to give us a competitive edge. Because starting out, we're just doing a basic momentum strategy, essentially. So that's the, so you're selling reasonably priced shares. Well, I mean, I don't know if it works that way, but like the way that it works is that there's like a minimum investment amount. Like you have to invest $1 million or you can't come in, right? But we're going to make it so that you only have to invest $1,000 and you can join the fund. You just have to have passed the test. There's a company called ATM that has a funny way. Let's look at that. ATN. Let's just say ATN Ventures. Is it ATN International? What does a sales and trader guy do in a bank like JP Morgan or Goldman? Well, there's lots of different trading desks at a bank like that, right? So the desk that I spoke to, when I had opportunity to talk to traders, there was a block trading desk, which means that you got really big guys or funds. They need to buy or sell a ton of something, and then they know that will have a big impact on the market, and it will be cheaper to have Goldman execute it for them. And so then they've already purchased it, and their job is just to execute it the most efficiently, right? But a really large portion of the trading jobs at a bank are really like over-the-counter markets where you have to call somebody to make a trade and things like that. So that's a completely different game. And like there, the edge is not knowing what's going on in the market and all of those sorts of things. The edge is in knowing who to call and being able to be a good negotiator with them and getting the price that you need. Right? So how do you pitch that to the lowest common denominator or a 401k, bro? Well, it wouldn't be marketed to the lowest common denominator, right? It would be targeted towards people that are making between $100,000 and $250,000 a year, right? So there's a lot more people in the $100,000 to $250,000 range than there are people in the 250 and up range, right? So people that already have money and they have some money that they want to invest, well, what's your best option? Put it into into an index fund, right? Well, we can provide you a more diversified return. So the return that you're going to get is going to be similar to the S&P 500 on a yearly basis, but in years where the S&P 500 will be down, our fund should be up big, and that's the way that momentum tends to perform. So it gives those people that are kind of upper middle class, it gives them access to more diversified trading strategies. I think there might be a lot of people with money that what you say goes over their head too. Okay. You know how the richest people made their money, like the richest people in the world, they made their money, right? They they weren't just investing in an index fund. Okay. These were like hedge fund managers. And what I would be doing is making it possible for you to invest in that. You weren't allowed to invest in that before. Now you will. And one of the things is that in order to pass that test, you're going to have to learn all of that stuff. So when you go through the education, you'll learn all those things. Right? I don't think BlackRock and banks do trading. Well, they do trading. I mean, they process transactions, right? That's where the majority of the transactions are kind of handled through, right? Are those big banks. But what they don't do is they don't try to predict the market, right? They're not trying to say, oh, I think that the S&P 500 will be here by the end of the year, and yada, like that. Those are hedge funds that do that, right? Yeah, unfortunately, in order to invest in this fund, you will have to pass the qualified investor test to prove that you are a informed investor. And if you want to just set it and forget it, well, then the disadvantage of that is that you won't have access to those opportunities, right? Every opportunity has a cost. And the cost of this one is that you will have to take some time and gain an education. I don't know. Here's the thing: is like Congress is the one that made the test, right? So there's got to be people that are going to pass it, right? And my whole idea is just okay. So there's going to be this new class of investor that passes test. Let's make products that cater specifically to those people. Yeah, recently. It was in I think it was in Biden's law, actually. I think it was in the American Rescue Act that Biden put into law. And the test hasn't come out yet, or at least I haven't seen anything about it coming out yet, but it was supposed to come out this year. So, I don't know. Maybe FINRA is dragging their feet, but haven't you asked me this before, D? Because the documentation on the page explains that really well. Let me explain what the indicator does, because I feel like that you don't understand what the indicator is doing. Okay. So if I look at all the limit orders that are out there right now. Oops, wrong color. I look at all of the limit orders that are out there right now, right? I could go in and I could say, add the first 5 levels and tell me what that it is totaled up. And then I add the first 5 levels and what are these totaled up, right? If you look over here in Jigsaw has this thing at the bottom, like if I tell it, show me 32 levels, and after the 32 levels, then it shows me what them all added up is, right there down at the bottom, right? Okay. Problem. There's all these guys that are constantly like stacking and pulling and stuff, right? So if I just say what are all of these things totaled up at the end of 1 minute, like at the close of every bar, go through what's currently resting on the bid and add it up, right? Well, then how can somebody screw with that? They can, just before the end of the bar, stack a bunch on here, and then you process it and you add it into your calculation, and then they pull it off, right? And then it screws it up, right? So what we've done is I've created some algorithms to kind of help you filter this out and detect when it's happening. So what I do is I say, for each price level, what's the minimum that price level was during that bar? What's the lowest that price level was during that bar, and what's the maximum that it was during that bar. And then that's where you get the max min and difference, right? So if you have a really big difference, what that means is somebody is continually stacking and pulling an order that is really big. That's what that means, right? If they're not a very wide difference, then that means that there's not a whole lot of stacking and pulling activity going on. So this is one of those things that you're just going to have to put on a chart and see how it goes and try and determine what you can do with it, because it was not built with like, you know, here's a strategy that I know should be profitable and you need to do this and do the correct strategy. It's not like that. You're going to have to figure it out. Like how, you know, I'm showing you data that we know we have. Let's see if you can use that data to make a strategy. Right? So that's what the indicator is doing. After 7 years on did you make it? Nah. I mean, to me, making it is being able to continue to trade, right? My question is, why does the market push up as the offers is increasing and slipping upwards? So you're saying that like the offers are bigger, but it moves up? Yeah, well, it'll switch. Like, that's the thing. Do I have a picture of it? So you'll see something where it's like, okay, so you get this histogram, like you get this zero line, and you get this histogram that will be like, the offers are bigger, essentially, right? And then when you look at price is moving up during this whole time, right? So what's happening is the offers are larger than the bids, and price is trending up. So that means that the price is moving into the liquidity. Now you will have other times where it's the opposite, where if there's a lot of liquidity on this side, on the offer, it kind of provides pressure and pushes them down. You will see the opposite of it too. So I'm saying that there seems to be like some sort of hidden Markov model sort of thing going on in here, because it shifts between regimes as to whether it goes towards liquidity or away from liquidity for some reason. Okay. But the thing that I have found interesting with that indicator is, you know, the offers will be larger. Here's my zero line. Offers will be larger, and then all of a sudden it will flip. And it will go to the bids are larger. And when that happens, it tends to be some sort of an inflection point in the market. Sometimes it's like a straight up reversal. Sometimes it's like the trending market goes flat. It's just like whatever it's doing at that time, it will change. And I can't predict what that change is going to be, but it changes. So I don't think that you can generate a signal just off of that one thing, but it is something that you can kind of add to you. So like one thing that you might want to, like that I want to do in my algorithm is just look at the inside two levels. Just look at the inside two levels and only take a trade if I'm in line with that. So, you know, right now, we got the inside two levels. It's most likely going to tick down, right? Well, okay, now it's most likely to tick up, right? So I take, well, okay, it's changing a lot because we just had the news, right? Let's see here. Oh, how come do I not have the squawk turned on? Hold on here. No, I don't. Okay, but University of Michigan sentiment final, 70.5 versus 69.1 expected, and 5-year inflation in line at 3%, and 1-year inflation lower than expected at 2.7 versus 2.9%. So maybe actually could provide us a little bit of a boost, but that's probably not enough for on a Friday that's been pretty choppy so far to take a trade. So let's just watch. Okay, but maybe if it slows down here a little bit, right? Basically, if I look at the inside two levels and which one is smaller, and so if the offers are smaller, then I'm going to buy, right? And if the bids are smaller, then I'm going to sell. And I'm not going to use that as like my only entry criteria, right? I'm going to, I'm going to be using all of this other larger stuff to determine where I'm, if I'm going to buy or sell. But what it's going to do is it's going to ensure that when I get in, I'm always at least kind of catching the edge, right? So that's what it was kind of designed for. And then again, there's these issues with like stacking and pulling, right? So if I look at that and I see the difference in the stacking and pulling and everything, that might provide me some data that I can use to like filter certain trades out and say, okay, when the difference is really, really big, I'm not going to take a trade, right? So that's what the intention with that indicator is. But there's some weird things with it. Just put it on a chart and study it. And I don't know how the line goes. It'll do weird things. But it seems to me that it's like when you see a change where it's like, it was up here and now all of a sudden it turns down really hard. As what happened here? Why did that, like the market makers all shifted? It's weird, but you'll see it. It happens. And you can only see it in that chart. So it's kind of weird that like you see such inflection points in there with something that's like only we're using, right? So I don't know what causes it, but so I think that we should make a new chart here, actually. Oh, you know what? I won't do it today because I don't have the fancy stuff applied to all of the indicators. So I'm gonna apply it to all the indicators, and then we'll make a chart. And I think that what we will do is we will put it back here where the market analyzer is. Where we used to have the S&P 500, and recently we've had the market analyzer, and I don't think that any of you guys really care. So I think I'm going to shift it with my chart that has the special indicators on it. And then that will be recording the data, and we can start doing some back tests on it, right? Or I think that I will also put this simple one that I've already created and start running the strategy. See if there's any issues with it, how it performs. Oh, so that does remind me, there's two other things that we need to add. So for the back testing, add time windows to advanced strategy base class, and what was the other one? I really hate it when that happens and I lose my train of thought. So it's my short-term memory there. But it'll come to me. I just have to go back to what I was thinking about. Oh, yes. Wait for a pullback. If I'm always getting 4 ticks of adverse excursion, then maybe the signal is good and I just need to wait for the pullback first. Which might be something to be able to incorporate into the advanced base strategy, but we'll see. When offers moving, well, but it doesn't mean offers moving up. It means, or are you saying that the line is like the offer line is moving up? that means that the number of offers, the number of contracts being offered is increasing. Yes. Try not to think of it in terms of supply and demand, okay? Supply and demand are terms that have been misused and I think just kind of screw you up, right? Because really when you want to think about it, it's sell supply, buy demand, sell demand, right? Limit offers are sell side supply. Limit buys are buy side supply, right? Market sells are sell side demand. Market buys are buy side demand, right? This is important. Too few people in retail understand this. Yeah, it's a two-way market, right? Because supply means people that are providing a thing, and demand are people that want the thing. There are two things that are offered and that are provided and demanded. Buying and selling. A position long and a position short. Right? So when you see a market buy, that is like most people think, oh, market buy, that is demand, and market sell, that's supply, but it's not. It's sell side demand. That's somebody that's demanding to be in a short position, right? So, but you see why? Let's just not use that terminology. Let's just use limit buy, limit sell, market buy, market sell. Yeah, the supply of offers increase, but the demand for offers increases more. There you go. That could be. Like if we're trending up and the offers. But then there's the other side of it, which is that, you could have a large sell side supply up here, but the number of contracts aren't actually trading, right? Like every time on that first price level, most of the contracts pull. Right. So what does that mean? We move up. Sell side supply is increasing, but cumulative delta is very small. That kind of suggests to me that market makers are just lifting their offers because of something going on in another market, right? I think they got shorts offside, and these shorts have to cover, hence the offer supply increasing. Maybe. So, like, if there's a bunch of people that are short, but why would they put increase offer supply, right? So, like, if you're short and you were going to provide liquidity for your exit, that would be a buy order, right? So you could see a situation where it's like we move down really strongly and then I see all of these big bids down below us, and that kind of suggests, oh, they want out, and we reverse. But my own observation of the markets is that that's definitely a thing in a situation that can be like incredibly powerful and that we would want to identify. But that it's so incredibly powerful that everybody knows it, and anybody that's in that position tries to hide it. I breathed something in there. What's that? Like dust or something? Oh, you know what it probably is? That the air in here is... I'm going to have to turn on the air filter. It's probably like pollen and stuff. Because you would want to go higher and higher, so you would pull the offers to get them in a worse position. Well, that it could be indicative of like spoofing activity, I guess. Yeah. Like one of the things that I've had a hard time sorting out is with the spoofing, because there's definitely situations where it's like that's a spoof, right? And they don't happen very often anymore. It's like you'll see it for a little bit and then it disappears, almost as though the regulators are doing their job. But then there does seem to be some other situations where I'll always see like a little bit of stacking there and stuff like that. And it almost seems like it's robots, and like what's causing that? And I don't really know. You know, it's like if we breached the high, why would you put a bunch of bids there? I don't understand. Other than to coerce the market into moving higher, I don't know. Why does it push? But that's what. But I think you're missing the bigger point that I'm trying to make here, D. It doesn't always do that. The behavior that you're seeing right now will change next week. I guarantee it. You'll see a day next week where it's doing the opposite. It does it a lot because it seems to do it in regimes, right? Like, because there's kind of like 4 options, right? There's like they're moving up and they're moving down, and then they're moving up into liquidity, and they're moving up away from liquidity, and then there's down moving into liquidity and down moving away from liquidity, right? And so you can just split that into, are we moving up or down, and are we moving into liquidity or away from liquidity, right? And what I'm saying is, if you go and you look at, you know, if this line is the whole month, right? It will be above it for a while, and then it will be below it for a while, and it's streaky. It's streaky. It's like if they were moving towards liquidity today, then they're likely to be moving towards liquidity tomorrow. But at some point within the next week, it will flip. And I can't predict when it's going to flip, and I don't know why it flips. But there's regimes to it for some reason. And I don't know why. That's the puzzle to sort out. So I think that underneath of this, there is this Markov model. That is like the hidden state of the market that we are trying to suss out is, are we moving towards liquidity or away from liquidity, right? And then we use a couple of different data series and indicators to say, based on these things in the past history, are we in the moving towards liquidity or away from liquidity? And what are the chances that in the next time period that we will switch regimes? And that's what a Markov model is designed for. One tick is a lot. One of the things, so this comes back to, and this is going to be like one of the next videos, and we talk about this all the time, but you got to understand the difference between resting liquidity and latent liquidity, okay? The reality is that the majority of resting liquidity pulls and never executes. The majority of the resting liquidity are orders that people at institutions are basically putting out there to reserve their spot in the line. So if they need it, then it's there and then they can tell it to execute. But otherwise, those orders will automatically cancel if there's any chance of them being executed, right? So the majority of resting liquidity does not execute. It just pulls, okay? Latent liquidity, though, is people don't want everybody to know what they're doing, so they don't submit their orders until just before it's going to get filled. It's like if people are hitting into 10 they're selling at 10 and I want to buy, then I put my order right there in with like the iceberg and whatever. And, you know, my order's only on there for a few seconds and then it gets filled. Those are the latent liquidity. And the majority of the volume that actually trades is latent liquidity, right? So what you're seeing by analyzing the resting bids and offers can only tell you so much. The thing that matters is not what the resting bids and offers are right now, but what they were and how they change and react to the other orders. If there's market orders in here, you know, how much of these orders at the next price cancel? That's what you're reading with order flow, right? Now, this is a granular thing, right? It's like we're looking at it as it goes along each little data point. That's something that a chart's not good at doing. That's something that's not good at doing. So to really replace that part, to really replace like our reading of order flow, we would probably need to create one of these chat GPT token sort of things where, you know, you filter for large changes in the bids and offers. And then you, every time that there's a change, that change gets processed into a token that is then passed to a large language model. And the large language model tries to predict what the next sequence in that is going to be. Hey, Paul, I'm gonna hop in there. So impact has a square root law, and then on the retest there is this 3/5 law. 3/5, what's that about? Okay, yeah, let's answer that. Okay, so the impact. What? I'm gonna draw pictures. The square root law is the impact of an order of size q is equal to y omega times square root of q over v. So as these guys come in with their market orders, they're going to push the market. And as they push the market, it's going to exhaust the resting liquidity. Or it's going to exhaust the latent liquidity until you get to a point where there's a hole, right? And then the hole is kind of hard to get out of. And so they just kind of, they execute in there and they get all of their volume filled, right? Okay. When that pressure stops, there, right? So you're buying, and then you stop. What happens once you stop? The market just rests where it is? Well, actually no, because you've left this huge wake behind you of low latent liquidity. So there's going to be high liquidity above you because you haven't gotten through those prices yet, but there's going to be low liquidity behind you. And so what tends to happen is there tends to be a post-meta order regime change, or short-term mean reversion is what I was looking for. So if we're like we work for a firm, okay, and we're executing together a big order, okay, they tend to do these things in teams, right? So we're going to do it in waves. We're going to do it in waves, and we're going to let it come up to this spot, and we're going to see the liquidity hole form. And then when the liquidity hole forms, I don't want to keep pushing the market, because if you keep pushing the market too much, there's actually, so the square root law is, I'm not drawing the whole thing. The chart goes like this, right? But then at the very end, there's like this spike. Okay. This spike right here, where your impact starts to increase exponentially, is very, very bad. You don't want this to happen, right? You don't want that. That's bad. Don't let that happen. Okay. So what you do is you pressure the market so that you're creating this square root law, because the square root law helps you. The square root law is beneficial to you. But then you have to back off and execute more slowly. right? And the thing is that if I create that square root law and then I'm done, like I'm completely filled and I'm not going to buy any more, the market doesn't just stay there. It tends to come back. It tends to fall back. Okay. I don't know why my line got so thin there all of a sudden. It tends to fall back. And the pullback follows the 3/5 law. Okay. There's some weird math that you can go into that's in the book that kind of explains why it's the 3/5 law. But basically, because it's the 3/5 law, it basically means that the time period, like, so here's the square root law and here's the 3/5 law. What it basically means is that the time of this, if this is, you know, X minutes, this will be 2.5X. Two 2.5X. Generally, it's around 45 minutes, though. That's what that's about. And so it's going to be 2.5 times in length, and it's going to be 3/5 a pullback. Right? Does that mean, I think that means it comes back more than half? Does it come back more than half? No, I think it would be less. I think it would be a little bit less than half. I think it's the 2/5 is the pullback. Anyways. But it's like it follows a YO times Q over V to the 3/5, right? So you can actually use that if you're really going to, like, you know, the volume and all of those sorts of things. You could pretty accurately predict when a meta order stops, how far the market will pull back. And then you could potentially say, like, okay, well, this has come back more than I would expect based on the square root law. So that must mean that somebody is actually executing an order going the other way now. Right? So that's what the square root law is about. Oh, nice. I was rewatching an older stream or a video. Yeah, I don't know, but older video. So see, part of the thing is that when I'm talking about that, and some of that is starting to venture a little bit beyond the research, though, right? Like, there's kind of this gap between the research and a practical application of it for a retail trader. And, you know, I don't want people to think, oh, well, you said that it should pull back this much and then it didn't. Well, the overall statistical number is that that's what it tends to do on average. But how much that applies to you in that particular situation and everything is unknowable, right? So I'm just thinking, my kit man yesterday. I did an interview yesterday, but before the interview, there was another person that wanted to get some information. Like, they were working for a company, and I think that they were going to create like trading education. And they kind of wanted to know how I did it. So I was talking to them, and while I was talking to them, the kids absolutely destroyed this room. They absolutely destroyed this room. They got all of the books out, and then they got chalk, and they drew over everything with the chalk. Oh, it was so bad. But one of the things was going through the books, and I remembered that I have the Ferengi rules of acquisition, or at least the parts of the rules of acquisition that are known. And I remember we used to read from it all the time, and we don't anymore. You know, what words of wisdom do the Ferengi rules of acquisition say? Rule number 33. It never hurts to suck up to the boss. Hey, there you go. I like that one. It never hurts. I'm just saying. Might hurt with me. I don't know. I don't feel like I'm very... When people start brown-nosing me, I start getting suspicious. Now I got the pen out. Now I want to write A, B, C, D, E, F, G. It's not bad. Anyways. Probably should have turned on my algorithm today. Nah, I'll do it. I gotta stick to my things. I got let's see here, and I do have some stuff today too. Oh, okay, but that's not until like noon, so we'll go and wake up the children though, because I bet you they're all still asleep. Yeah, and weekend should be a pretty good opportunity to establish the routine a little bit better so that they really go to sleep. We did pretty good yesterday with it, like doing the routine. They didn't go to sleep, but didn't go to sleep very quickly, at least. Let's read what Zero Hedge has to say about the Michigan sentiment numbers. The final data for the University of Michigan sentiment survey in October surprised Brigley to the upside at 70.5 versus the 69 expected. Notably above the 68 spot non-preliminary print, as both current conditions and expectations sub-indexes jumped significantly from their flash prints. Inflation expectations tumbled to 2.7. I wouldn't call that tumbling, but it did decline. More or less in line with the general trend from the Conference Board's inflation expectations, the upcoming election looms large over consumer expectations overall. The share of consumers expecting a Harris presidency fell from 63% last month to 57% in October. Oh, so those sentiment numbers probably don't fully reflect what the result of the race is going to be. That's interesting. Sentiment of Republicans who believe a Trump presidency would be better for the economy rose 8%. On growing confidence that their preferred candidate would be the next president. As usual, independents remain between, with a 4% gain in sentiment this month. Regardless of the eventual winner, a sizable share of consumers will likely update their economic expectations based on the results of the election. Yeah. I'll see you next week. Thank you for stopping by. So, what do we got going on? Well, the S&P 500 has been rallying pretty strong there, huh? Wow, that's almost 30 points up, in fact. Is it 30 points? Yeah. So 30 points. That's interesting. Oh, you know what? I just remembered something. Now that I got the pin out, I saw this application that looked interesting. It was called Excalidraw. Yeah, and can I make it? Okay, so here's this thing. Can I log in? How does this work? References. Oh, I can just save it. Oh, I have to. There is this place to sign up. I sign up. Oh, in order to sign up, you have to pay for it. $7 a month. Oh, you can always use the forever free version at over here. Okay. But so what is this? So this is selection. To move canvas, hold mouse wheel or space bar while dragging. Okay, but like, how do I... Well, here, rectangle. Cool. Arrows. Looks super dry-like. Draw. Oh. That's interesting. Cool. Text. Image. Eraser. That's pretty good. More tools. Frame tool. Laser pointer. Oh, that's cool. Laser pointer allows me to switch between. That's something that my pen drawing tool doesn't do. Is like I can make it so that it erases, but I can't have like this part stays and this part erases. Pen mode, prevent touch. What does that mean? Keep selected tool after drawing. Can I change the canvas to black though? Canvas background, I can. How come there's not 0, 0, 0, 0? There we go. Da-da-da-da. Snapshot for blackboards. I don't know if it really provides the one advantage that this provides over my pen over here that I typically use is that I can, like, if I come in here and I draw stroke opacity, make it blue, right? And then I can like zoom out and like move around and stuff like that. So like if I draw something and then I'm like, oh, but I need more space, then I can start drawing over here, right? So that might be useful. Cool. Oh, and you can do live collaboration. That could also be useful. Oh, look, there's the thing. There we go. We use the canvas background to make it dark. There we go. System mode. Dark mode. That's better. Why giving up on using volume for each swing wave? I'm not sure what you're talking about, to be honest. Saw it on your first live traits. Like, are you talking about like way old videos? I think that there was some things that I don't know. There was a lot of stuff that, like, you know, we used, and I don't necessarily know why we used them. They just interested me at the time. And eventually I got bored of them and forgot about them. And, you know, those were things that we didn't really have a whole lot of empirical evidence to support anyways. That's kind of part of why I shifted, you know, the longer this is gone, the more I realized that, you know, spending time on things that I really had absolutely no evidence to suggest were a thing was actively harmful to the trading. So I would just forget things. Now this is interesting. That drop from the open down to here, that happened awfully quick. Because I remember when I was drawing, we were up here. Man. That can't have just been from the sentiment numbers either, because it's been almost 36 minutes since that happened. It does seem like that we're moving down overall since that happened. I guess one other thing that I would say, amen, is that there was some things that I looked at that seemed like there was really something to them, but they were too rare. For instance, there was one thing that I had where it was kind of like a volume profile, but it was showing the cumulative delta difference. So it was like, here's the cumulative delta now, and this is what the cumulative delta was the last time that it was at that price, and what is the difference between those two, and that's what it would show me. And so that was pretty good, effective at identifying situations where like there was potentially trapped traders based on the cumulative delta and everything. But I found that it was like once a month where it mattered, and so I just kind of stopped paying attention to it. Christy? Is that what it is? What else would you say are things that people should forget about which do not make sense or do not have any statistical backing? Well, like the big one is that the change in price on an intraday basis doesn't really tell you a whole lot about what's going to happen. So all this price action nonsense. But I mean, like, pretty much everything that retail traders talk about probably fits into that category, right? Pretty much everything that retail traders tell you is bad, and then, you know, just read the research and try and build something off of the research. It's really bizarre to me how ignorant the retail traders are of the market research. But it is what it is. Why do you still use volume profile on the DOM? Well, you know, I think part of it is probably just that I like the way that it looks. I mean, so there is something that we see on the DOM, right? That is this kind of normal behavior right here. And the evidence that we have suggests that happens because of liquidity holes, right? So what that kind of tells us is that the last liquidity hole that we had was at 12. I find it useful to remember that, especially when we're in situations where like there was a liquidity hole there and like we're reapproaching that situation, that spot. So it might be an interesting place to look at. It's also nice to know what the point of control and what the VWAP is, even though I'm not explicitly taking signals off of them. So I guess it's probably more of a comfort thing than anything. But the thing that I do use on the volume profile that does matter is, again, we're trying to get an idea of what the latent liquidity is in an area, right? And you can really only see that as it trades. But then, you know, afterwards, the evidence that you get of what the latent liquidity in that area was is the volume profile. So it's, you know, I'm actually looking at the numbers here. Like I note that 55,000 per price is about average, right? If it was showing me like a million or in the 80,000s in those prices, that's a little bit unusual. That's like high. And what was with that, right? So that's something to pay attention to. Otherwise, I could probably take the volume profile off and save some space, right? I wouldn't say that I trade history liquidity. It's kind of like, well, so the thing is that so like we had a lot of volume up here at 12, for instance, right? So I think that the kind of pitfall that a lot of retail traders would fall into is, okay, this was a point of control. That means that we are likely to trade back to this area. So I should take a bet that nothing's happening and that it will bounce and go back up to that's what they would typically say, and especially with liquidity history. Okay, but what do we know? We know the square root law and the 3/5 law, and we know that this is going to be 2.5 times this. Right? This is going to be X. Okay, so what we know then is about 2.5 times the duration of the move, which tends to be around 45 minutes in the treasuries. So about 45 minutes afterwards, the liquidity should be healed. In other words, since it's 45 minutes right now, this doesn't matter anymore. There's nothing special about this price anymore. Retail traders and people might try and trade that, but if we move back up, I should not necessarily expect the liquidity hold to form at 12 again or anything like that, because it's been too long. It's been too long. Now, on the other hand, if I started to see, like we've come down here, if I started to see some aggressive buying down in this place, right? I start to see some aggressive buying, and it's only been like 15 minutes, right? Like what we moved up here, we started to get this, and then it did this. Somebody sold it, and now I'm starting to see it do this. Then I should expect it to come back to here, assuming that it's within that 45-minute range. Right? So I guess you can kind of use the history, but only 45 minutes back. Once it's past 45 minutes, it doesn't matter anymore. Right? The way that because I just got to be careful about, because what the majority of people teach with those tools are like nonsense, right? Because what most people teach is find the point of control for the previous day and then trade around that. Well, it doesn't matter anymore. And the point of control for the previous day was probably the closing price anyways. Christy, you have to go back to work, but it's nice to know you're healthy and positive. Yeah, thank you very much. I'd love to see you again. You can always check us out on Discord or, leave comments in the videos. I appreciate it, guys. Octavia says, crazy flows again all the way back to the lows. Well, so I don't know where you're getting again from, but I'm thinking this reminds me a lot of yesterday, right? Love you, man. See ya, thanks. This reminds me a lot of yesterday, where it's like it kind of, trades all the way across the range multiple times without much of a rhyme or reason. Is it the French fry trade again? It could be. I mean, the thing that I get from the sentiment numbers is that like consumers may have already adjusted their expectations about who's going to win the election and what happens after the election, but it is not showing up in that survey because the surveys are delayed and it takes a certain amount of time and all of those sorts of things, right? So does that mean that there's stuff that's not priced into the market yet? It could mean that. It could mean that. It didn't convince. What part did not make sense? Can I draw 2 scenarios out or something to try and explain what I mean here? So you gotta move. It goes like this. And now let's draw it a little bit more carefully. Okay. This is X. This is 2.5x. Okay. So now, if I get a buying impulse again, should I expect it to do something at these prices again and get stuck? No. Doesn't matter. Doesn't matter. It's just going to do the same thing again. Oh my gosh, that was so terrible. It's gonna do the square root of law again. Right? If scenario B we get a sell here, what is it going to be? If this is X, it's going to do this. Where this will be X as well. And these Y's will match up. No price change, right? No change. Okay. Scenario 3. We move up like this. And we start to come back. But before the 2.5 comes in, you get this. Right? And let me draw it a little bit better. So it's like proportions matter here, right? It's going to be like way bigger. This is a loss. So if you were to buy something and then immediately afterwards sell that thing, you'll have a net loss. This will be X, but this will be, this section right here will be greater than X because the liquidity hasn't healed yet. Do you see what I mean? Right? Now, conversely, if I get something like this, so now there's this next scenario. This is where some of these get kind of weird and complicated, right? We gotta move like this. Then we gotta move like this. And then somebody comes in again, right? And what's it gonna do? It's gonna go even further. Oh, it's like a double inverse. So what do people identify this as on the chart is actually this, right? This is I think they call it the ABC pattern, right? This is the ABC pattern. I mean, the chartists, they all think this is a pattern, and when you see it like X is likely to happen afterwards, the pattern is the thing that you would be trying to predict, right? If you were somehow able to predict 3 conflicting flows, right? Okay. But there is a chance, if this isn't big enough to really push through, like right here at this point, right here, there's going to be more liquidity in this area. How do I get it to do the laser pointer? Okay. This area right here, there's going to be more liquidity there now. So it's going to be hard for them to push through this. They're going to need some real volume to push through this. If they don't, then it's likely to just get stuck in this hole again, right? And then you get so let's do it. Then you get this where it's like that, and then you get this, and then you get this again, right? And it just gets stuck at this same spot, right? Which is like a double top, right? So, well, you're saying that most retail traders put their stop loss right here. Well, so that's a nice theory, but can we prove that? I don't know if that's actually true, to be honest with you. I mean, it seems like a reasonable theory to me. It sure seems to me that, like, when you break a new high or a new low, that, like, market volume can come in pretty aggressively. But I also see situations where we break a high and a low and, like, nothing happens, right? So, like, what you're doing is no offense, but that is improper use of deduction, is what's doing. As you're saying, here's a theory that seems reasonable, and then from that, you're trying to deduce all of these things about the market. But the reality is that we do not actually have empirical evidence to prove those things, right? And that's kind of the test, is like, deduction is great. Deduction is great, but in the market, we have to back deduction up with empirical evidence, right? Because our understanding it can be so flawed. That's why our hero is not Sherlock Holmes. Our hero is scientists that measure things. I don't know who is a famous scientist who is the hero of empirical evidence. I'll have to look that up. No, there's not only two types of orders in the markets. I mean, technically you can categorize them into buy orders and sell orders. But you can categorize them into limit orders and market orders too. And then if you really want to get complicated, icebergs is a different order type. There are market if touched orders. There are, there's actually a lot of different types of orders, right? And then there's stop orders, right? But stop orders are like market orders if a certain price is touched, essentially, right? So it's like, you could potentially categorize, well, I would say that within the research, that researchers typically tend to categorize market participants as liquidity takers or liquidity providers. Sure. Karl Popper? Who's that? British academic. Okay. One of the greatest philosophers of science of the 20s. I'll have to read about him later. But still, the assertion that you are making is that this should never happen. Essentially, right? Like, if we come back up to that high and we break that high, it should break out because there should be an area of stops and we should just blast through that, right? Well, but all I'm saying is that because of this area right here, or sorry, because of this move right here, the liquidity here is going to be lower than the liquidity here. You might be right that there might be an increase in market orders at some point, but there's going to be more limit orders here than there are going to be here. So that's why you get this situation where it's like if it hasn't been the 45 minutes, it's easy for them to pull back, but it's hard for them to break the high again. Right? If I want to see them break the high, it's better to get this, right? Where they move up, they wait the full 45 minutes, and then a second wave comes in when the liquidity is healed. If I'm a big player that needs to buy a lot and I'm going to be buying all day, this is the ideal situation for me. This is going to give me the best execution. It's basically waiting for the liquidity to heal. Now, this one isn't bad because, actually, I guess maybe this one is better. But what I should say is that as retail traders, this is what we're looking for. This is kind of the standard simplest one. But, this leg and this leg could be the same guy, right? And it's just like, oh, somebody else sold against it, so why not do that? But if that's the case, and somebody else comes in and aggressively starts selling it, they probably come in and support it, right? It probably doesn't get that low because he would immediately start taking advantage of all of that sell demand coming in and absorb it. Saf, how are you? Oh, I haven't seen you. Man, you're getting so many people coming back after, it's been a few weeks or months. Right. But the key thing that I'm trying to tell you is that a lot of it depends on how long it's been. What the latent liquidity does, right? And there's another thing here is that there's this big wild card, which is market orders, right? Because I can only say, based on the current liquidity conditions, this is kind of like the lay of the land, right? It's kind of like you're playing golf, right? And there's all these curves in the ground and stuff like that, right? But you still can choose how hard to hit your putt, right? So this situation can turn into this situation, right? This 1 and 2. It can turn it if there's enough market orders, right? It's just that it's going to take more market orders than usual to make this happen. So it usually doesn't. I guess kind of what I'm saying is that, like, if you get a pullback, like it's a really quick pullback and then it's right back up there and it's like only been 10 minutes, it's usually not worth going for the break of the high trade there because it usually doesn't happen. Nothing prove your words. Well, so the square root law is proven. The square root law is one of the most consistently proven, empirically backed behaviors of markets. Like the two most empirically backed results that we have on markets is the square root law, 1, and 2, volatility clustering, which is what most option strategies are based on, right? So, and the 3/5 law is also empirically proven. Now, all of this stuff is kind of like, I don't think that they do studies on that, right? I'm just trying to use now the square root law to explain to you how it changes how the market acts, right? It's basically how the liquidity changes the lay of the land and potentially changes how you want to look at things. That part is not empirically proven. Should be clear, right? That part is me using the market data that we have and using my deduction, right? And unfortunately, I don't think that you would be able to prove these ones because, like, you would have to have something that is like every major meta order and then like watching the different streams of meta orders and comparing. It would be too complicated to do an analysis like that. But these are just kind of situations that I'm kind of drawing out, right? And I also remember that part of the key here is that I'm saying is like, this is a pattern. This is a pattern that will happen. One of the things that I'm saying is there are patterns in markets, but patterns are results, not signals, right? People think that pattern, people think that you do a pattern trade, and that should equal some result. Blech. Right, that's how retail traders think of things. Is I wait for the signal, I take my trade, and then I should get the result with a certain percentage. Right, and after I do this 1,000 times, I should get a certain amount. That's the way that retail traders think. But what I'm saying is these things that everybody is looking at as patterns are actually the results that you're looking for. So what I'm saying is you take expected flows plus, geez, that's a really bad looking plus. Let me try that again. Plus liquidity conditions okay, and that will result in a pattern, which is actually the results that you're looking for. Okay, so the patterns that most retail traders are looking for are like where we're getting out of our trades, essentially. That's what we want to see happen. And when we see the pattern, we were correct with our prediction and we're getting out. So, book on scientific research that shows the research don't count as a proven thing. Wait, what are you talking about? Are you asking that? I don't think that answered the question. Oh wait, what? I don't even remember what we were talking about anymore. Oh, you're right. Saf is at university. That's why he hasn't been around. Well, I appreciate you being around though. Proven for me means scientific research or logical necessity. Well, all I'm trying to say is, okay, so like, here's the thing. Right. If I take fact. Oh my gosh, I'm so terrible at this today. If I have a fact, right, I can then go
block
logic, right, conclusion. Okay. And this is called deduction, essentially, right? Is you're taking known facts, you're using deductive logic to then reach a conclusion and prove something, right? Okay. There's a flaw in this method of doing things. There's two flaws, okay? 2 flaws. Oh, you know what? On this thing, I think I can go like cross it out and do text. Okay. So there's 2 flaws. Oh my gosh, how do I make the font size bigger? Normal, code, font family, hand drawn. Oh, font size, large, extra large. Okay. 2 flaws in deduction. Okay. 1, we suck at logic. Okay. 2, we don't have all the information. Right. So presumably, based on the laws of logic, if we know everything about a system, then we should be able to use logic to find out what's happening, right? But if we don't have all of the information, there might be compounding factors that we don't understand that results in a different outcome that we don't expect, right? So that's why in science we use empirical evidence, right? So like deduction is a great way to come up with a theory. We can say, based on what we know about the world and everything, this should happen, right? Then you go and you do the science process. You set up an experiment, you set up controls and everything so that we can balance out other compounding factors and so forth. And then we can see if our empirical evidence backs up our conclusion. Right? I feel, like, when you think about it, like, we all learned this in school, but do we actually think of it? Do we actually think of it in this manner? I don't think that the thing that they don't teach you in school that I kind of feel like that they miss here is like why we do the scientific process. Well, because what would happen is people would say, oh, here's a fact, and your logic, and conclusion. And everybody would do that with the different information that they would have and all come to completely different conclusions. And the conclusions that they came to did not always match the real world. So how do you know who to believe or what to do? Just go follow the person that's the richest? Well, that's the way that most people do it. But no, if we really want to know something, we have to use empirical evidence. Empirical evidence is the only way to really, really know. To really, really know. So we can go and we can, collect the data and prove that something works. Right? Now, the funny thing about it, as it relates to trading, I don't know how you zoom in or out. The funny thing about this as it relates to trading, and let's make this a little bigger too, is that in trading, if it was truly proven, there wouldn't be an edge in it anymore, right? People would have already done it, right? So in trading, there will always be this gap right here. Oops. I wanted to use the laser. This area right here. In trading, there will always be a gap there. You will always have empirical evidence to prove a certain thing, which would be like some other fact or conclusion, but there's still going to be this gap where you're kind of have to take a leap of faith and hope that your understanding of the situation is good enough to make the trade, right? This is and there's a word for this. This is called faith, right? Always at the end of the day requires a leap of faith to take the trade, unfortunately. Okay. But all I was saying, the thing that started this discussion, right? All I'm saying is the theory that there is liquidity, or sorry, that there are stops above the high and the low, and that will result in market orders if it is breached, is not proven as far as I know. Okay. It's a good theory, but it's not proven. So then we could come in and we can say, well, can we prove it? We might. We could. Actually, I think we can. Because Bookmap, it has this way of looking at market by order data, and that they can kind of detect stops. So what the market by order data does is they say every order, every update that you get is basically on an order by order basis. So it'll say, here's this order and it has ID, whatever. So can I do this? Let's try moving in here. Oh, it's control. Okay. So what it does is it basically says, here's order number, 777, and it is a limit sell for 500 lots, right? And then the next update that you'll get is order number 777 is actually now a limit sell for 700, right? So with normal data, you would just see, oh, it was 500 now, it's 700 now. But I can actually see it by like the order. And so if I have all of those updates, what I can basically do is I can determine, we can draw it with a square. I can say, here's the queue, and here's me. Oops, no, let's not do it that way. Let's use the arrow. We can say, I'm here, and the order 777 is here. Number 777. And this is me. Okay. Now, because I know which order changed and where that order is in the queue relative to me, I now know that that order was in front of me in the queue and that my place in the queue has improved. Okay. That's what market by order data is meant for. Okay. Well, there's something interesting that can happen. Is what happens is it actually comes in like update order. Let's say this is order 778 now. And it is now market by 500. Okay. Well, how does that work? How do you get an update? How do you get an update that's a market buy? Shouldn't that be a new order? Shouldn't that be just a new, it would be new order number 779 or whatever. How can it be an update? Because that was a stop. It was a stop and it was converted into a market buy, and that's why it's an update. So that's what they're doing in Bookmap, is my understanding. Is that every time that an order comes through that is a market order that is marked as an update, it says that's a stop. So we could probably do some study that says when we breach the high, do we see more of those stop orders or not? Is there any kind of statistical aberration in what prices the stops are placed at? And we could study that. It seems to me like that is something that people should study, and I don't know why there hasn't been a study for it, but There hasn't been a study for that. So we don't know. We don't know. Right. Now, some of this stuff over here, some of these are actually kind of a little bit proven. So this bit right here, where, you know, each time you're going across, the impact increases. That's proven. But it's kind of on the hush hush. Okay. So just trust me, that one is proven. Okay. It's kind of weird because I think all of the researchers know it too, but nobody seems to want to publish it. But I'm pretty sure that it's proven. Now, what are you talking about here, Matthew? It's all in the first chapters of that book, The Iron Rule of Explanation. The Knowledge Machine by Michael Stevens, which states that in science, disagreements and disputes must be settled solely through empirical testing and evidence. Ah, there you go. Wow, perfect. Right. But and like, yeah, I mean, this is essentially the problem with essentially the entire retail trading education industry and discussion, is that everybody has these ideas about how the market works. And I wouldn't even necessarily say that they conflict, but I think that in many cases they do conflict and the retail traders don't realize it. And nobody is using empirical evidence to back up where these disagreements are. They are all just relying on somebody that came up with a theory for how the market works based on what they knew. But some of their facts might be incorrect, some of their logic might be wrong, and there might be other information that they don't know about that would change their conclusion. And so you end up with all of these retail traders that have basically been miseducated. I mean, understand the empirical evidence that we have. It teaches us some very limited things. It's just those limited things actually have insane power. Those limited things actually have insane power. Okay. All of these funds, index funds, hedge funds, etc., 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 they wouldn't work if the square root law was false. The square root law is essentially what allows them to scale up and trade so big. So discussing the algorithm, this is good for backtesting with some stricter requirements on the stack rolls and some, yeah. I really, so for the thing that I'm trying to build, I really want to use like the resting orders as a filter. I want to use the resting orders as a filter for direction and also a filter for times to just not trade because there's shenanigans going on. Anyways, that was like 20 minutes over. I don't got anything. And it's Friday. It's Friday, but I do have some work that I want to get done. And, no, I want to put a video on Monday, and I think that I should be able to get that one. The video on Monday should be about dark pools. So the main thing is I just got to get like a good thumbnail for it. So. GG. Yep. Guys, I kind of don't want to end it. Do you do Java or Python? I do everything, man. I've used Java, I've used Python. Probably more Python than Java at this point. Because I do Python with personal stuff. But I'm most experienced in C#. So. And I have this like whole thing where like I have this data and I want to like, process it with Python. And then use machine learning and stuff. But that's that's the next project after I'm done with this backtesting cache data. And this one may kind of be extended because like we keep getting good results with the backtests that we do. So, I truly hate Java. My understanding is that it's gotten better since I used it. Like professionally, at least, since I've used it professionally. There's still a lot of problems with libraries and stuff though. So quant Seth, yeah. Yeah, it is. Well, I mean, the whole thing has been like, I'm a programmer and I'm on the quant side. It's just that so far my intuition has performed better than any of the strategies that I've been able to program. It's like kind of the bum deal is that the proven behaviors of markets have very limited application to what we're doing, where we're trying to day trade, futures with like one contract and all of that sort of stuff, right? I mean, they kind of help us, but like those proven things, like at best, they get you to break even. You have to have something that's going to predict future orders. And like sometimes we have that and sometimes we don't. And when we do have that, I think that I only know that based off of intuition. I wouldn't be able to program those things. You can email speculatorSeth@protonmail.com is probably the best way. Which reminds me, I've got 2 people I got to respond to now. So, but I'm going to get going and go wake up children. Stay excellent, team.